Welcome back to Mastering MHA MBA. This is the final part of our Chapter 5 series. Today we cover hybrid costing systems, the joint cost problem when one process makes many products, and the common cost allocation puzzle when two parties share a facility. Part 1 was the foundations and the 5 steps. Part 2 was weighted average versus FIFO. Now we close the chapter with 3 real-world wrinkles that pure process costing cannot handle on its own. By the end of this video, you will be able to recognize when a hybrid costing system fits, allocate joint costs at the split-off point, and apply 3 common cost allocation methods including the Shapley value. Process costing assumes identical units. Most real production is not that clean. Cars on a Ford line move through one continuous process, but each one carries a unique trim package. Hospitals run a standard surgical workflow, but every patient has their own implants and supplies. We need a system that captures both. A hybrid costing system blends job costing for the customizable inputs and process costing for the standardized conversion work. Direct materials get traced to the specific work order. Conversion costs get averaged across all units that pass through each operation. Best of both worlds when product variety is high but the conversion work is repetitive. The textbook calls this operation costing. Adidas and Nike both use it for customized sneakers. The customer picks colors, materials, and lacing. The factory traces those direct materials to the specific order, but the cutting machine, the stitching robot, and the QC scanner do the same operation on every shoe. Conversion cost per shoe is identical. Materials cost is unique. Same logic in custom prosthetics, in mass customization, and in modular healthcare service bundles. Baltimore Clothing makes 50 wool blazers on work order 423 and 100 polyester blazers on work order 424. Wool needs cutting, edge checking, sewing, seam checking, and hand-stitched collars. Polyester skips edge and seam checking and uses machine sewing. Materials cost $6,000 for the wool batch, $3,000 for polyester. Conversion costs follow the operations each batch actually used. The wool batch totals $10,080. Polyester totals $8,835. Different paths, same operation rates. When product variety gets too wide for actual costing, managers use a standard cost rate per operation. Set the budgeted conversion cost per unit at the start of the year. Multiply by units processed. Variances at year-end tell you how reality diverged from plan. We cover variance analysis in a later chapter. Now to a different challenge. Some processes inherently produce multiple products at once. Refining crude yields gasoline, diesel, jet fuel, and asphalt. Slaughtering a cow yields prime cuts, ground beef, leather, and byproducts. Distilling coal yields coke and natural gas. You cannot make one without the others. The cost incurred up to the split-off point is a joint cost. How do you spread it? The split-off point is the moment in the process when individual products become separately identifiable. Before that point, all costs are joint. After that point, any further processing is a separable cost, traceable to the specific product. Managers care about joint cost allocation mostly for inventory valuation and cost of goods sold reporting. The most common allocation method is sales value at split-off. Take each product's selling price at the split-off point, multiply by units, and use those proportions to spread the joint cost. The logic: products that command higher market value benefit more from the joint process, so they should bear more of the cost. When split-off sales values are not observable, managers approximate using selling price after further processing minus separable costs. Be honest with yourself. Any joint cost allocation is arbitrary. There is no physically correct way to split a cost that is fundamentally shared. Sales value at split-off is the most defensible heuristic, but it is still a heuristic. CFOs use it consistently, document it, and move on. Decisions about whether to process further or sell at split-off use incremental analysis, not allocations. Common costs are different from joint costs. A common cost arises when two or more parties share a facility, activity, or contract, because sharing costs less than going alone. Two companies share an environmental remediation contractor. Two hospitals share a regional MRI suite. Two business units share an IT platform. The total bill is one number. The question is who pays what. Two companies, Delpin and Cambry. Delpin's standalone cleanup cost would be $120 million. Cambry's would be $80 million. Together they can do it for $150 million, saving $50 million versus going alone. How do you split the 150? Three named methods, three different answers. The standalone method allocates the shared cost in proportion to each party's standalone cost. Delpin's share equals 120 divided by 200 times 150. That is 90 million. Cambry's share equals 80 divided by 200 times 150. That is 60 million. Both parties save versus their standalone cost, often viewed as the fairest method because every party gets a proportional share of the savings. The incremental method ranks the parties. The primary party absorbs its full standalone cost first. The remainder goes to the incremental party. If Delpin is primary, Delpin pays its full 120. Cambry, the incremental party, pays the remaining 30. If Cambry is primary instead, Cambry pays 80 and Delpin pays 70. The choice of primary party drives the answer. Every party wants to be incremental, which is exactly why this method is contested in real negotiations. The Shapley value averages the two incremental allocations. Treat each party as primary once and incremental once, then average. Delpin, 95 million. Cambry, 55 million. The Shapley value comes from cooperative game theory and is widely viewed as the fairest method when no party is obviously more responsible than the other. Three methods, three answers. Standalone gave us 90 and 60. Incremental gave us either 120 plus 30 or 70 plus 80, depending on who is primary. Shapley split the difference at 95 and 55. Same total, three different splits. The right method depends on context, contract language, and who is at the table. In a hospital system, this is the IT chargeback debate. The EMR platform serves cardiology, oncology, and the ED. How do you split the platform cost? In a managed services agreement, this is the back office allocation. In an MBA case, this is shared overhead between two business units. The math is identical, the politics are not. Cost transparency rules in 2024 and 2025 have pushed hospitals to publish service line costs. That is forcing finance teams to defend their allocation choices to regulators, to payers, and increasingly to patients. The methods you just learned are not academic. They are board-level decisions. CMA writers love this material. Expect a multi-part problem with standalone, incremental, and Shapley computations on the same data, plus a short answer on which method is fair. Show all three calculations. Pay attention to who the primary party is in incremental. Watch for the Shapley value as the average across rotations. Quick recap of the whole chapter. Process costing fits identical units in volume. Equivalent units convert partial work into full unit equivalents. The 5 steps walk you from physical flow to cost assignment. Weighted average pools costs and equivalent units to date. FIFO uses current period only. Hybrid costing handles mixed production. Joint costs use sales value at splitoff. Common costs use standalone, incremental, or Shapley. That is chapter 5. If this series helped, the next chapter on cost volume profit analysis is up next. Drop a comment with what you would like covered. We read everyone. Subscribe to Mastering MHA MBA, source for this chapter. Datar and Rajan, Managerial Accounting, Pearson. Thanks for sticking with us through chapter 5.